Hey everyone, and welcome back to the channel. Today, we're diving deep into a company you probably interact with more than you realize. Intuit Incorporated. Think QuickBooks, TurboTax, and Credit Karma. We're going to break down their recent stock analysis, understand what makes them tick, and figure out if they're a good fit for your portfolio, all in plain English. Section 1. Intuit's big transformation from software to fintech powerhouse. Visual aid, on-screen text. Intuit, from software to fintech ecosystem. With QuickBooks, TurboTax, Credit Karma, MailChimp, logos appearing. First up, Intuit isn't just the company that sells you tax software once a year anymore. They've gone through a massive makeover, transforming from a traditional desktop software vendor into a full-blown, cloud-based financial technology ecosystem. Imagine your old tax CD evolving into a super smart financial assistant that helps with everything. Visual aid, split screen, old desktop computer icon versus modern cloud icon. They've used their dominant position, especially with QuickBooks for small businesses and TurboTax for individual taxes, to build what we call a moat. This means it's really hard for competitors to catch up because of high switching costs and the huge amount of financial data Intuit has. Their big strategy now? Integrating artificial intelligence, or AI, to offer done-for-you experiences. This means the software does a lot of the heavy lifting for you, saving time and headaches. They serve about 100 million customers worldwide, giving them a massive data advantage to make their AI even smarter. And by acquiring companies like Credit Karma and MailChimp, they've expanded their reach even further, covering everything from marketing for small businesses to managing your credit. Section 2. How Intuit makes its money. Visual aid, infographic showing the interconnectedness of QuickBooks, TurboTax, Credit Karma, MailChimp. Let's break down Intuit's main money-making engines. QuickBooks and MailChimp. For businesses, visual aid, quick snippets of QuickBooks interface and MailChimp emails. QuickBooks is their core. It's essentially the operating system for small and medium businesses. It handles accounting, payroll, payments, you name it. The shift to QuickBooks Online has been a huge success, with online accounting revenue growing by 22% last year. By integrating payroll and payments, they make it super sticky for users, creating multiple ways to generate revenue from each customer. Think of MailChimp as their way to help businesses find customers before QuickBooks helps manage them. It's all about creating an all-in-one platform. TurboTax, for consumers, visual aid, TurboTax logo morphing into TurboTax Live, with a professional assisting. For individuals, TurboTax is still king for DIY tax prep. But the big growth story here is TurboTax Live. This isn't just software. It connects you with a real tax professional right through the platform. This "do it with me" model significantly boosted their revenue per customer by attracting people who usually go to assisted services like H&R Block. TurboTax Live revenue grew by an incredible 47% last year. Credit Karma, for your finances, visual aid, Credit Karma app screenshot showing personalized financial recommendations. Credit Karma, which Intuit acquired a few years ago, is all about personalized financial management. It uses your credit data to recommend things like credit cards, loans, or insurance. This platform is a powerful data engine, giving Intuit insights into consumer behavior and allowing them to offer more targeted, helpful services. Credit Karma revenue jumped 32% last year, showing its strong performance. Section 3. Intuit's financial health growing strong, visual aid, line graph showing Intuit's revenue growth 2021 to 2025. On-screen text. Consistent double-digit revenue growth. So, how healthy is Intuit financially? Over the last 5 years, they've shown consistent double-digit revenue growth. This is largely thanks to their successful shift to a subscription-based model, meaning recurring income. Even with big acquisitions, like Credit Karma and MailChimp, they've maintained robust growth. Visual aid. Bar chart comparing net margins 2021 to 2025. On-screen text. Profit margins recovering strong. While their profit margins dipped a bit during those big acquisition integrations, they've bounced back strongly, hitting over 20% in fiscal 2025. This tells us they're running a very efficient operation. One important note, Intuit's business is very seasonal due to tax season, so their third fiscal quarter, ending April 30th, is usually their biggest. Section 4. What gives Intuit its edge? Visual aid. Pie chart showing U.S. SMB accounting market share. Intuit 62.23%. Intuit has some serious competitive advantages. For starters, their profit margins are fantastic. With gross margins around 80%, they have plenty of cash to reinvest in research, development, and marketing, crucial for staying ahead in tech. In the U.S. small business accounting software market, QuickBooks holds a commanding market share of over 62%. That's huge and creates a powerful network effect. Many accountants use and recommend QuickBooks, making it even harder for new players to break in. Visual aid. Animation of Intuit Assist. AI helping with financial tasks, e.g., categorizing transactions. But their biggest moat right now is their focus on AI and data. They're not just adding AI, they're integrating it deep into their platforms with Intuit Assist. This AI can do things like automatically categorize transactions, generate invoices, and even reconcile accounts, freeing up human experts for higher value advice. This strategy is also key to their expansion into the mid-market, larger businesses that need more than basic software but aren't ready for massive enterprise systems. This means bigger customers and more revenue per user. Section 5. Investing in Intuit. What's in it for shareholders? Visual aid. On-screen text. Dividend contender. 13 years of increases. For investors, Intuit offers an interesting blend of growth and stability. They've shown a consistent commitment to returning capital to shareholders. They've increased their quarterly dividend for 13 consecutive years, making them a dividend contender. Their payout ratio is around 30%, which means the dividend is well covered by earnings, leaving plenty of room for future increases. Visual aid. On-screen text. Share repurchases, boosting shareholder value. Beyond dividends, they also buy back their own stock, which helps boost earnings per share for existing shareholders. So, whether you're a growth investor excited about AI and market expansion, or a value investor looking for dominant market positions and consistent shareholder returns, Intuit offers a compelling story. Section 6. Risks to consider. Visual aid. Red warning icons appearing on screen for each risk point. No investment is without risk, and Intuit is no exception. 1. Regulatory risks. The tax preparation business is always sensitive to government changes. While the immediate threat of a government-run free tax filing system, IRS Direct File, has subsided for now, future political shifts could always bring it back. They also face scrutiny over marketing practices for their free filing options. 2. Execution and integration risks. Successfully integrating big acquisitions, like MailChimp, is ongoing. If they don't realize the expected benefits, it could slow down growth. 3. Macroeconomic sensitivity. Intuit serves many small businesses and consumers who are sensitive to economic downturns. A big recession could lead to more customer churn or reduced demand for credit products on Credit Karma. However, because accounting software is mission critical, it does provide some resilience. Section 7. The big picture. Is Intuit a good buy? Visual aid. Summary bullet points. Dominant market position, strong financials, AI-driven growth, shareholder-friendly, easing regulatory headwinds. So, summing it all up, Intuit has successfully transformed into a data-driven, AI-integrated financial technology fortress. They hold a dominant market position, especially in U.S. small business accounting, and their financials are strong, with consistent growth and recovering margins. Their commitment to AI and expansion into the mid-market are key future growth drivers. While the stock trades at a premium valuation, this is often justified by its quality, recurring revenue, and high growth potential. The recent easing of the IRS direct file threat also provides a clearer path forward for their consumer tax business. Visual aid. Long-term investment potential. Graphic. For investors looking for exposure to the digital transformation of financial services, Intuit offers a rare combination of stability, high-quality earnings, and significant growth potential. It truly stands out as a benchmark in the financial software industry, and could be a compelling candidate for a core long-term holding in your portfolio. What are your thoughts on Intuit? Do you use their products? Let me know in the comments below. Don't forget to like this video, subscribe for more financial insights, and hit that notification bell so you don't miss our next deep dive. Thanks for watching, and I'll see you in the next one.